Hey everyone, and welcome. Today, we are diving deep into one of the most powerful and, let's be honest, controversial tools in all of finance, the leveraged buyout, or LBO. This is a strategy that has built some of the biggest fortunes out there, but it has also led to some truly spectacular collapses.
Okay, so to make this all real, we're not just going to talk theory. We're going to look at two companies you definitely know whose entire futures were decided by this one financial maneuver, and their stories, well, they perfectly capture just how high stakes this game really is.
On one hand, you've got the legendary 1988 buyout of RJR Nabisco. I mean, this was a monster deal at the time, the biggest in history, and it turned into a massive win for its private equity backers. And then, on the other hand, Toys R Us, everyone's favorite toy store, taken private in 2005, and well, we all know how that ended, bankruptcy. So that's the big question, right? How can the exact same strategy lead to such completely opposite outcomes? One a massive success, the other a total disaster. That's what we're going to unpack today. And to do that, we really need to understand what an LBO is, and, maybe more importantly, why they even happen in the first place.
Now, before we get into the nuts and bolts of how these deals work, we've got to look at the problems that LBOs are supposedly designed to solve. And it's going to sound a little weird, but sometimes having too much cash can actually be a sign that a company is in trouble.
So to get why a pile of cash is a problem, you got to understand the basic idea. Just think of an LBO like this. A firm comes in, puts down a pretty small amount of its own money, like a down payment on a house, and then borrows the rest to buy the entire company. And here's the kicker. The company's own assets and its own future profits are then used to pay back that giant mortgage. So that extra cash lying around, it basically becomes the fuel to pay for its own takeover.
Okay, so the first big theory here comes from an economist named Michael Jensen. His whole idea was that when a mature company is making a ton of cash, but doesn't really have many great new places to invest it for growth, the managers might just, well, squander it. They might waste it on silly projects or fancy perks instead of giving it back to the actual owners of the company, the shareholders.
So here's the main takeaway. A company that's flush with cash isn't always a well-run company. That big pile of cash can actually be a huge red flag for inefficiency. And that makes it a really attractive target for an outside firm that thinks, hey, we can do a much better job managing that money. And then there's the second problem, something called earnings myopia. You know how publicly traded companies have to release those earnings reports every 3 months? Well, they pretty much live and die by those numbers, and that creates this immense pressure to look good right now.
So what does that mean in practice? Well, it means a public company might slash its budget for research and development, or maybe it'll cancel plans to expand, all just to make the next quarterly report look a little shinier. This kind of short-term thinking can absolutely cripple a company's future, leaving it weak and vulnerable to a takeover.
Okay, so we've laid out the problems. Let's get to the solution. This is where private equity firms step onto the stage. They look at these issues. Too much cash, short-term thinking, and they don't see weakness. They see a massive opportunity to unlock a ton of hidden value. All right, this slide just breaks down a few key terms for us. The LBO, that's the main tool we're talking about today. Now, sometimes a company's own managers are the ones leading the buyout. We call that an MBO. And other times, the strategy is even bigger. You buy one company to use as a platform, and then you use it to buy up all its rivals and basically consolidate an entire industry.
So how does one of these huge company-altering deals actually go down? Well, it's not random at all. In fact, it follows a very structured, step-by-step playbook every single time.
And this shows that journey perfectly. It all starts with finding the right target company. That's followed by the super intense investigation called due diligence, where you check everything. Then comes the really complex part, arranging the financing, then the legal closing of the deal. And finally, you have this multi-year process of trying to improve the company, all before selling it for a profit, which is what they call the exit.
Out of all those steps, putting the financing together is without a doubt the most critical. It is a total high-wire act. It determines the risk, the potential reward, everything. If you get this part wrong, the whole deal is pretty much doomed from the very beginning. So this is typically what that financing looks like. The private equity firm, or the sponsor, they only put in a tiny slice of their own money. That's the sponsor equity you see there. The vast majority of the price is borrowed. It's usually split between safer senior debt, which is kind of like a regular bank loan, and then riskier, higher interest mezzanine debt.
Okay, so now we get the playbook. Let's go back to our two case studies. Because with all this new info, we can see exactly why RJR Nabisco took off like a rocket and why Toys R Us crashed and burned.
And this slide really just lays it all out, doesn't it?
The absolute crucial difference was the business itself. RJR Nabisco was basically a cash machine. It had super predictable profits from food and tobacco, which is perfect when you need to make giant debt payments. Toys R Us, though, it was stuck in the brutal, fast-changing world of retail. It needed cash to adapt and compete, but that debt was eating every last dollar. And for Toys R Us, the size of that deal was just staggering. That $6.6 billion price tag wasn't just some headline number. It translated directly into a crushing mountain of debt that the company had to start paying off from day one.
Think about it. The interest payments were so massive, they became like a black hole, just sucking up all the cash the company was bringing in. There was literally nothing left over to remodel the stores, to build a modern website to compete with this rising online giant called Amazon, or even to just match the low prices you'd find at Walmart and Target. The company was being starved of the cash it needed to survive.
And this right here gets to the very heart of the LBO story. The debt, that's the leverage, is what supercharges the profits for investors when things go right, but that exact same leverage also supercharges the risk, making the company incredibly fragile if its performance just stumbles for even a second. It's a double-edged sword.
So, this brings us all the way back to our big question. What are these things really? Are LBOs a necessary tool for corporate discipline, for shaking up lazy, inefficient companies and forcing them to be better? Or are they just a dangerous financial game that puts investor profits ahead of the long-term health of a business? As our two stories show us, there's no simple answer. And that, right there, is what makes the world of leveraged buyouts so endlessly fascinating.